All right. Happy Monday, family. Okay. When are interest rates going to go up? For whatever reason, this is the question I'm getting right now. Most of the videos I make are usually just, hey, I've been getting this question a lot, so let's make a video about it. And this is relatively straightforward, I think. I'm going to show you what I'm looking at. I'm going to show you what everyone's looking at and ultimately give you what I believe is going to take place. And also, I'm going to tell you what other people are saying. I am pretty non-biased on this. I hope that rates stay low, but I'm not biased as to whether I think they're going to go higher or stay lower in any way. Derek Evans here, VA Home Loan Specialist, NMLS 155010. Let's get to it. Let's see. I'm going to get myself out of here, I think. Get me out of here. Let's get this out of here. All right. So a couple things. First of all, when Federal Reserve Chairman Jerome Powell testified before Congress here, he talked about how they're going to speed up bond buying. I talked about that in another video. They're going to speeding up the tapering of bond buying, I should say, meaning they're going to buy less and less bonds. And we're going to look at the chart here in a second. I'm actually really zoomed out today. I want to show you kind of the macro move of what's going on there. So they said that, hey, we're going to pull out a little bit quicker than we were talking about taking it easy. And just kind of rolling out nice and slow, nice and easy. We're going to actually get a little more aggressive on that. And they also mentioned that they were talking about potentially increasing rates as soon as next year. I think it's going to happen actually earlier next year. This pivot on inflation where he switched from saying transitory to saying, hey, it's probably a good time to retire the word transitory. That's not good for bonds. That's really, really bad. But I want to give you sort of the overall macro outlook, and then I want to show you on the micro where I think we might actually have a chance here before the end of the year to do a lot of refinances and get a lot of good rates locked in. So let me just show you kind of what's going on here. These are bond prices, okay? When bond prices go higher, rates go lower. When bond prices do this number right here, Yesha Maria, look at that. That is when rates go higher. So when bond prices drop like this, rates go up, right? Well, overall, if we just look here, okay, after this double top here, which is going all the way back to the very beginning of the year, that's all in January, by the way. Since then, the overall trend has definitely been down, right? I mean, look where we are today. So overall, we can say that bond prices from where they were to where they are today, they've gone down, which means that what? Rates have gone up. All right, this is a quick test. So rates have gone up, not massively, but they have gone up. They've gone higher. And that's just what's happening. And that's okay. I wish I saw a little more strength in some of this. I wish I could say that, man, there's something really big that we can land on. There's nothing big here. When you zoom out, it just looks like a bad looking chart. It looks like a chart that tells us about inflation, which I've been telling you about for months. And the Federal Reserve has finally admitted that they were wrong about it. Okay, well, let's zoom in a little bit more now. Let's just go back to, let's say, September. Okay. And we can get rid of, we'll go ahead and refresh it, which just kind of automatically erases everything. By the way, all this information, mbshighway.com, if you want to sign up for your own subscription, you can do that and get this data, because it's not easy to get this data. It's hard to find this data. All right, so what do we got here? What do we got going on? Each one of these candles is a daily candle. All right, so right now what we have that's somewhat interesting, and I'm going to give you the bull case here. We have this reverse head and shoulders pattern here. Now, unfortunately, the right shoulder is lower, but it's all wick. It's all wick. If you really were going to say, hey, I'd like to draw my shoulders more where the solid candle lines are, you could make a case for, hey, the right shoulder is higher than the left. Is that a big deal? It is typically. It is typically, because that does mean that it gives us a higher chance to get some trajectory. So even though we're down 16 basis points here today, and we seem to be creating this super duper tight range here. I mean, look at this. Super duper tight range. This would be great if you're a trader to just put your orders in on the other side of this thing and see what happens. Of course, it doesn't always work, but you've got this range, this super tight range here, this consolidation that's going on. Unfortunately, all the resistance is overhead. We've got resistance here, we got moving averages here and here. So all of the resistance is above us. So that's the bad news. The good news is that I think what we saw in the zoomed out chart when we went back all the way to January, what we were looking at here in this downward movement is we were seeing just a reality that the market understands that inflation is here. And so a lot of the bond traders, or people who are income investors, if you will, seem to have already exited. In fact, you can tell right here, a lot of that already took place. Look, we're higher than we were after this big exodus in March. So it kind of makes you look like, okay, well, this over here to the left, this was just a little bit, maybe fake. Let's just say let's call it what it is. It's fake because the Federal Reserve is in there buying. That's how they got us up this far. Once that seemed to be off the table, at least at some point in the future, exodus, right? Create a new level. And that new level is right where we're dancing right now. Okay, we are dancing right here, right now. This line right here goes over here. And that's where we're at. So it feels like it's sort of a bottomy looking chart. This where we're at right now sort of feels like it could be the bottom. And we've actually crested through this line a couple of times. But note that each time that we did it, it didn't last long. And then when you see this big green candle right here, let's zoom back in to look at that beauty. When you look at that, look, it just blasted through that thing and reestablished. So it looks like we're trying to form a bottom here, guys. I have no idea how that's possible. I have no idea. It makes no sense, but it is what it is. This is why it's important. When you look at these things, try not to have a bias. Try not to have an emotion. Just look at it, see what it is. It may not make any sense what's really going on, but it is what it is. So to me, it looks somewhat like we might see an opportunity for rates to dip lower here between maybe now and the end of the year. The only thing keeping that back, and by the way, we're down 16 basis points today, but what is that on the heels of? That's on the heels of the Dow being up 646 points. Look at this. Dow's up 646 today. I mean, that's a humongous day. Typically, when stocks are rallying like they are here in this scenario, you would see bonds sell off pretty hardcore. Not today. We have a little red candle here, but we also have a nice wick on the bottom of that guy. So we have, I would say, what appears to be some demand, some bond buying demand. Now, that demand might be entirely made up of the Federal Reserve buy button. But regardless, it looks to me like the Federal Reserve has said, listen, we are willing to buy right here. Maybe they are the ones who created this bottom back here. Of course they are. So if they created this bottom right here and said, yeah, we'll buy at that level, maybe they were out of cash, at this moment here and had to wait a couple days before they could juice it back up. I don't know what their trading plan is. I don't know what their rules of engagement is, but it sure looks like they're setting a bottom. Now, if you were a trader, if you were an investor, if you knew that a big entity, a big buyer or a big seller was setting a price mark, what would you do? You know what I mean? So, I mean, I feel like it's only a matter of time here. We could get a spike. Now, I don't think this spike is going to last. Okay, let's go to the outlook here. I do think we could get a spike here in bonds, which would cause rates to dip for a second. But overall, we're going to see bond prices go lower because look here, when we determine that this is sort of this double line right here that we have, this right here, I'm going to show you exactly where it is. There you go. That is, let's call it the bottom. Okay, the floor that's been set by the big buyer. Well, look, here they were clearly out of money or asleep at the wheel or something for a few days, and things didn't get too crazy. But this is where things would have headed. I mean, without this big buyer coming in here and creating this huge green candle, I mean, look where it was going. So, in my opinion, this is happening probably next year. I would say at some point in the first part of the year, we'll really start to see that bonds are not able to hold, especially if the taper takes place multiple times between now and the first quarter. But I also think that we could see the stock market really get hit because if the Federal Reserve also increases the interest rates for the overnight lending window, then that would put a lot of pressure on stocks. It would, even if it was a small amount, even if it was 50 basis points, it would put some pressure on stocks. And that pressure on stocks could in turn be beneficial for bonds. So while I do think we will see rates climb higher, I think there's going to be pockets of opportunity. And I'm really excited about it personally because as a loan officer who studies this stuff and is all over it, that's going to be really good. It's going to be a great way for me to be able to provide value for the people who are trusting me, to do this for them. The days of just, you get a loan in, just go ahead and lock it, whatever things are today, those have been over for a long time. Unfortunately, a lot of loan officers still operate that way. This coming market, this next 13 months, let's call it, is going to be a time for the more analytical, more market participatory loan officers to really be able to add value and to deliver value to their clients by locking them at the correct time. And I always feel like I've done a good job of that. Sometimes, we miss. At the end of the day, it's always still the client's decision. I just try to inform them about all this stuff. And right now, we're just kind of in a situation where who knows what this inflation really means. Crypto, as I saw, it's running a little bit today. Ethereum just continues to fly high. XRP has become very interesting. I'm going to do a video on that here soon. Let's look at oil. Oil back up to $70. Again, that tells you right there all you need to know, especially about this word. It starts with an O. Not a real threat there. Okay, oil is the ultimate truth serum, and we can trust it. Okay, it is real. It is an open market that helps you gauge demand for goods across the world. And right now, until they have battery-powered boats and barges, which could happen one day they could be solar-powered. Who knows? But as of right now, that tells us all we need to know. Gold slipped back under 1,800. Sorry, all you gold bulls. I feel bad for you. I really, really do. It's a painful thing to watch the price of gold. But your stock portfolios did well today. So that's good. I just don't think that we have a lot of people saying, hey, rates are going to go up, rates are going to go up, rates are going to go up. I do think they will, but I think we're going to see a more volatile scenario where you just have to be in good hands in order to capture a decent rate. And this is very true. Right now, if you're in a refi situation, I'm floating here. I'm not pulling the trigger on this. I'm going to float right here for my refi clients, and we're going to see what happens. But I think the risk reward makes sense, because if we can get a pop in the interim, in the next, let's call it 3-4 weeks, which is totally possible, that could very well be worth it. However, the floor is right beneath us. That's been set multiple times. Could that collapse? Possibly, but not with a huge buyer in place, which is what we know we still have. Even with the first round of tapering, we're still going to have a huge buyer. So I feel like the risk reward makes sense, knowing where the floor is, to say, you know what, let her ride. And we'll see if I'm right tomorrow. And of course, I probably have that blocked. No, I don't. Okay, cool. All right. That's it for today. If you have a call or if you have a question, give me a call, shoot me a text, send me an email. If you want to buy, you want to refi, Derek Evans, NMLS 155010. Guys, have a great day.